A few years ago, I did a huge mistake on stock market when I was on a dividend strategy that made me lose almost $13,000 in 3 years, 3.5 years. And I will explain you in this video why I did this mistake, how I could avoid it, and how to avoid it in the future, and how as well you can avoid it. So note something, it's on my previous strategy. Before it was a dividend strategy. So I wanted companies that give dividends. So I started buying Walgreens because it was a king dividend. I started in 2021, something like this, around $45, $48 per share. Then it declined. I continued to buy. Okay, I bought more at $40, more at $35. I think since it's under $28, I never bought again because it was also starting to represent a big part of my portfolio. And you can see now it's $11 with an average price of $40. I invested a bit less than $20K in this company, and now it's worth like $12,000. So it's a 72% decline. Of course, I received some dividends for 2 years because now they cut it, but still a very, very bad performance. So you will see two things in this video: why I did this mistake, how to avoid, plus that it's not really bad in the sense that the portfolio is still positive. It didn't block the portfolio to have positive return. So you will see how to still do mistakes and have a positive return for your portfolio. So why I bought this stock? Okay, the first reason is it had a dividend over 4%. Okay, it's a gigantic business, growing revenue. The payout ratio was healthy. Okay, if you look at the payout ratio, the moment I bought it was 35%, 38%. It never went over 50%. Okay, even for the free cash flow, it wasn't too bad. It started to be bad in 2023, but at the moment I bought, it was still fine. Free cash flow payout ratio, payout ratio. It was a king dividend. Okay, 50 years of growth, year over year. It was growing, and it's a huge business. Okay, Walgreens, you have really a lot of Walgreens in the United States, and Boots. In London, you have a lot of Boots. You have Boots in Asia when you travel and so on. In airport, you have Boots in a lot of airports, especially in Asia and in UK. Okay, so that's why I bought it. It's a giant. As I told you, I started to buy around $45, and I believed it was deeply undervalued because at the moment they had problem with government because of the opioid drugs in the US. You had a big scandal over this, and Walgreens was in the middle of this, and plus they had some other troubles. But I was really convinced that the company was undervalued because of those problems. The investors were overreacting about those problems. Here, the things that happened after this. Okay, since then they decrease. Like they never stop to decrease. To be fair, I never ever have been on positive in this company. Since I bought, it's always been declining. I never knew a day in green. They changed the CEO 2 years ago with hope that it would change, but except cutting the dividend, nothing changed. Okay, they realized that plenty of stores are not profitable, and unlike, for example, Best Buy, which is kind of a declining business a bit, but the way they manage it so well that they focus on stores that make money. So they can keep growing their incomes. With Walgreens, the revenue is growing, as you can see. Okay, they have a revenue which is growing, but their margin are declining, and the earning per share are declining as well. They were still doing buybacks. Okay, they don't create new shares, so they don't dilute shareholders, but the business is declining even if they have more sales. So the problems come from really the management here. Then they first reduce the dividend and then cut it like 9 months after or a year after. And now it's at $11. How could I avoid this kind of mistakes? First, not only focus on value, but also on growth potential. Like Walgreens never had any growth potential. Here you can see it expects to have $1.50 earning per share, which is still declining for the next 12 months. And it was like this in the beginning. Never I saw it with a potential growth. It was at the beginning more stable. It was supposed to be more stable the next year, but never like a big growth potential. So that's the first mistake you can avoid. But this, even without the growth potential, when it's deeply undervalued, you can make some money on it. So there is other sign. Avoid companies with low margins, even if it's normal for the business model. Here you can see the operating margins, 1%. I bought around 3%, 2%. Okay, it's very low. It's twice lower than it was a few years ago, and it's declining. So if I put more attention to the margins, okay, if I consider it more important, I will not make this mistake. But I was focused on dividend. And when you look at this dividend, 50 years of growth of dividend plus a payout ratio like this, you feel it's kind of healthy. But no, it wasn't healthy. Second problem, okay, how to avoid. Accept to sell if you're not going according to the plan. I had the opportunity, okay, listen to the signs. I had opportunity to sell 2 years ago. I was on a trip in Miami in 2023, I think. I went to Walgreens because I was like, okay, I'm in the United States. Let's go to Walgreens and see how it is inside. The store was empty. You had CVS not far away. It wasn't full, but you had people in there. 7-Eleven, same. Everywhere you had people. But in Walgreens, it was almost empty. I was also in New York. In New York, I didn't see Walgreens. Maybe I didn't pay attention if I saw one. I saw CVS, but I didn't see Walgreens. So here it could be signs that tell me, hey, you need to maybe reconsider it. Plus, Boots in UK, if you go in London and so on, you will see Boots, they are full. If you go in the airport, Boots are doing very well. But the problem is Boots is not the main revenue for Walgreens Boots Alliance. Walgreens is still the biggest part. And they have a lot of stores, but so many stores that are not profitable. So if I listen to myself when I enter in this Walgreens in Miami, I should have sold. Okay, and this after this that I decided to never buy again because I saw how it is inside. So I should have sold here. It was around $25 at this moment, I think. So I should have sold, and it will avoid me losing that much. I will still lose, but less. Okay. Also, accept to sell if it's not according to plan. Avoid company with low return on invested capital or return on equity. Here you can see the return on equity was kind of fine when I bought. Okay, 9%, then 15%. But it decreased. Then return on invested capital, I never had over 10%. Now that I'm focused to outperform the market, to more quality company, like less deep value company with dividends, but more into quality company, like I never buy a company with return on invested capital under 15%, or if I don't see that 15% can be achieved in the next year. For example, Amazon, which have return on invested capital growing and growing because they are more profitable. At the moment I bought, I didn't have 15% return on invested capital, but I believe that in 3 years, 5 years, they will have a return on invested capital over 15%. Here with Walgreens, I never knew any time higher than 10%. Same with margins, okay? So this is a way to avoid this kind of mistake. You want return on invested capital over 15% if you want to outperform the market, and over 10% as well if you want to not to outperform the market, but create a strong dividend portfolio. Then avoid company with net debt to EBITDA over 3. Net debt to EBITDA, it was never under 3 except in 2017. And it was only 1 year under 3. All the years, it's over 3. And if I avoided it, I would not make this mistake. Interest coverage, same. It was over 8 before 2019, but since 2019, it never been over 8. Always higher, always under 8. And that's not really good. I bought when it was at 4, then it became at 9, and now it's 2, 1, 1. And it's not really good, especially with high interest rate, and especially that they have the credit rating, which is weak, getting lower, lower, lower. So this is something that could help me also to avoid doing this mistake, because the number were not lying. The number were already here. Like it had good probability to not be a successful investment. Okay? Avoid declining income, declining margins, declining revenue as well. Here the revenue, as we said, it was improving, so fine. But the net income, the EPS were declining. And this, I should have seen it in 2021. Yes, it got better than 2020, but still lower than 2019. And then 2022 declining, 2023 declining, and no growth potential. So I should have sold at this moment, but I didn't do it. So same, if you want to be profitable, remember that on the long run, the price of a share is very correlated to the earning per share, to the earning per share evolution. Here you can see declining year over year. You see the performance declining. Before, if you look, it was growing since 2019. If you take if you check the company, you go here, since till 2000, here it started declining in 2015, and then declining, but it was still stable while the net earning per share were growing. Why it started declining? Because they saw that it should see declining. So you see the market like kind of saw it a bit before, but in 2018 it wasn't very declining. It started to decline really around here, 2018, 2019. They feel that it was a top for the earning per share. Okay, and then listen to the sign. For example, the story with Miami store, with New York and so on, where nobody was there. I was in Las Vegas a few weeks ago, and here actually Walgreens have good store. They are cheaper than CVS, and you have people inside. It's clean, it's working well, but it's only in Vegas that I experienced this. Everywhere other than I've been, it wasn't very good. So this is how you could avoid mistake. The good thing with this is like, even though I lost 71%, 72% on this investment, it didn't destroy the global performance. I mean, it did bad performance for the dividend portfolio, of course, but the dividend portfolio, it's on profit. Yes, it could be more on profit, but it's still on profit. I think in 3 years, not including dividend, it made 10%, approximately 10, 12%. It's bad, okay? Let's be fair. It's bad performance. I want to be fully transparent here. My goal wasn't to outperform the market. My goal was to have dividend, to keep dividend and to grow my dividend. But it wasn't too bad. It wasn't too bad. It was just like I had my dividend increasing, but bad performance, underperforming the market. Now I want to outperform the S&P 500. I want to outperform the market. So I avoid at all costs this kind of company, because if I have a performance like this on one of my company, it will be bad. How can you avoid as well this kind of mistake? If you're in a dividend portfolio, don't invest more than 10% of the portfolio in one company. If you want to outperform the market, like focus on good quality business. Don't try to find some knife falling and that will rebound. Don't try to find like deeply undervalued stock, even if like that don't have any potential growth for the earning per share. Like go focus on companies that can grow, that have good quality, and really focus on good debt level plus high return on invested capital. Those two things, good debt level, high return on invested capital, will avoid you, I think, 90% of the mistake and of the losers on the market. As Howard Marks says a lot, okay, you can listen to his memo and so on. He said a lot, if you want to be successful in investing, do your best to avoid mistake. Don't try to find winners and so on. Avoid mistake. It's like in a tennis game. When you're amateur in tennis, you just need to give the ball back. If you avoid doing mistakes, the opponent will do the mistake and you will win. On the market, it's the same. Try as much as you can to avoid mistakes, and generally, if you avoid mistakes, you will be successful. And remember, you will, of course, whatever you do, have some bad company in your portfolio. You will have some which will do poorly, okay? First, you need to give the time. Like, don't sell after one year. Like, give the time. Give 3 years before it. For example, with Baba, it needed 3 years before really growing. So give the time to the stock. And if the fundamentals are really declining, like sell it as fast as you can. Like, don't bother. But if the fundamentals keep looking good, like keep the stock, be patient, okay? And it should pay on the long run.